to PhillipCapital's Experts Talk. My name is Lindsay from Phillip Securities Research. Today, we are privileged to have Mr. Stephen Tong, Director, Senior Equity Product Specialist from HSBC Global Asset Management, to share with us some of his near-term prospects on European equity markets. Mr. Stephen joined HSBC in 2014 as a Senior Equity Product Specialist, supporting global, European, UK, and thematic equities. Previously, he worked on sustainable solutions as Head of Emerging Markets Portfolio Management at Bank Vontobel. Prior, he was at AllianceBernstein for 12 years in Singapore, Tokyo, and London, in roles including Associate Director of Global Growth Research, President and CEO, AllianceBernstein Japan, Team Leader Japan Equities, Co-Team Leader Global Thematic Growth, Global Sector Head Telecommunications, and Research Analyst. Mr. Stephen started his career as a strategist consultant at Bain & Company. He holds a Master of Business Administration from Stanford University, an MS Food Science from the University of California at Davis, and a Bachelor of Science Mechanical Engineering and Nuclear Engineering with high honors from the University of California at Berkeley. Mr. Stephen is a CFA charter holder. Thank you, Mr. Stephen, for taking time to attend this interview with us. The European Central Bank, ECB, took several measures to stimulate the Eurozone economy early in this month. First, could you share with us the general economic situation in the Eurozone and why the stimulus package is perceived to be necessary?
The economic situation in Europe is mixed, and that's why the ECB took action. They've actually lowered their growth target or growth estimate from 1.5% GDP growth to 1% GDP growth, and importantly, their inflation target, inflation estimate from 1% to 0.7%. And it's because of this lower inflation number that the ECB decided to act. And if you look at the underlying data, besides the GDP growth, the purchasing manager indices are actually turning up. Many are above 50, but there's differences by country. UK and Germany are positive. France is lagging a bit. Consumer confidence seems to be rising. Domestic demand, leading indicators indicate will rise. But at the same time, there's a very large output gap, and we know unemployment is still fairly stubborn. So that means inflation, unless the recovery picks up a lot of momentum, inflation will be low. And the ECB wants to stave off the chance of deflation. So that's why I think they acted.
What is the potential impact for the rest of the global economies?
Well, I think it underpins the economic recovery in Europe. And Europe is a key trading partner for the US and for Asian countries. In terms of Asia, I think about 25 to 30% of imports and exports are with Asian trading partners. And so that's a fairly, having a healthy Europe is very important for the global economic recovery.
How did it affect your near-term view of the market and investment strategy?
I think our near-term view is different from our long-term view. Our long-term view is that we fully expect economic recovery in Europe, and on a 2 to 3 year outlook, we expect equity prices to deliver some positive returns. In the near term, though, because of the sort of mixed economic forecast, I think some caution is warranted.
Learning from the previous financial crisis that hit the region, no doubt that the banking system played a very important role in the European economy's health. However, while the Europe's systemic banking risks have yet to be resolved, stimulus program today, which includes negative deposit rate and targeted long-term loans to banks, is aimed to encourage the banks to lend more money. On the other hand, down the road, the ECB will be conducting its comprehensive assessment of lenders' balance sheets before it becomes the Euro Area Bank Supervisor on November 4th. In particular, an Asset Quality Review, AQR, which is scheduled to end next month, and to be followed by a stress test that runs into October. Do you think that the measures come a little too early? And in your opinion, would these measures work to fight the threat of deflation in the 18-nation currency bloc?
I think the most important part of the ECB's actions is to signal that they stand ready to underpin the economy and the recovery, and that they're in a position and they're ready to fight deflation. It's very much a signaling effort, and when you look at what's coming ahead with the asset quality review that you mentioned, I think the market going into those reviews and the subsequent assessment of the bank's balance sheets, plus perhaps some capital raising requirements, I think the market needs to have comfort that if there's a negative surprise, which we hope there's not, but if there's a negative surprise, that the ECB is ready with additional policy measures, including quantitative easing. Now, if you look at exactly at the essence of the different policy measures that were taken, we don't believe that they will have that much of an impact on the real economy. The negative deposit rates, well, banks don't hold that much deposits at the ECB right now. They can easily park their money elsewhere, like in low interest bonds. They will offer low-cost loans to banks in the hope that they will then relend to other institutions and corporates. That helps ease the transmission. Will yet to be seen if the banks actually take that up. And then lastly, they will be buying some securities, which include packages of loans to non-financial institutions. That says in a bit of a way that they're ready to engage in asset purchases, quantitative easing, in a small way. But they stand ready, and that's very, very positive for the market.
What are the other risks to monitor? For example, the recent dovish measures considering overheating local real estate markets in Germany?
Well, regarding Germany, it's interesting that there's a perception there's a bubble in German property prices. The information I have says that property prices are only up 15% or so in the last 3 years or so. Whereas in London, where I live, the prices have risen 18% in a year. And so I think Mark Carney and the Bank of England are interested in that being a bubble as opposed to the German situation. Now, of course, if you look at the sort of normalized policy rate in Germany, it should be about 5%, whereas the ECB rate is about 25 basis points. So the low interest rate is very stimulative for the economy. But German asset prices, as I said, haven't appreciated that much, and German households remain with low leverage, and so we're not as concerned there. On the unemployment side, particularly in Spain, where youth unemployment is very, very high, 40% plus or so, that is much more of a concern because that could lead to social issues. And in particular, we know in the parliamentary elections, the far right gained a number of seats, and they're very nationalistic and anti-immigration. So yet remains to be seen how that plays out, but when the people are unhappy, that could have other consequences. A couple other issues I would point out. There's an issue in Ukraine. We're not sure how that will resolve, but a lot of energy imports into Russia, into Europe from Russia, transit through Ukraine. And also the conflict in Iraq could have some effect on energy prices, which could help maybe stall the economy a bit. So I'd be much more concerned there.
What about the stubborn unemployment rate in Europe, which remain a wild card?
Well, you need the economy to start bubbling and simmering for there to be job creation. And as we saw in the U.S., when the U.S. was coming out of its trough, all eyes were fixed on job creation numbers. I don't have the numbers for Europe in front of me, but what you want to see is activity levels increasing and then jobs being created, and then the unemployment number comes down. But in the periphery, wage rates have fallen quite dramatically. And these adjustments that the periphery has taken, strong Germany can help provide demand for goods from other member states. I think the situation between what's happening in Spain and unemployment is very different from the situation you had in Japan, where the government and the policymakers did relatively little for 10, 15 years to fight off deflation. So I don't think this unemployment leads in that direction.
Which are the industries or sectors you are most optimistic on?
In our portfolios, we're very overweight the cyclical sectors: consumer discretionary, industrials, financials, because we have a positive outlook on not only the economy, but the companies that we're buying are quality companies generating good levels of profitability and trading at inexpensive valuations. We think that's where the value is in the market. And if you take a longer term view, medium term view, 2 to 3 years, we think there's value in those stocks.
Could you also share with us your investment strategy as well as investment philosophy?
Well, we believe that there's a well-established relationship between profitability and valuation. More profitable companies deserve to trade at higher valuations. Sometimes in the marketplace, because of noise in prices or information, the valuations are depressed relative to the levels of profitability that are being generated. And this poses a potential investment opportunity. If we can determine through our fundamental research that profitability will be sustained, then we would expect valuations to reflect that. If profitability isn't going to be sustained, then perhaps the low valuation is justified. And so we look at the universe and try to identify those specific situations where there's a disconnect between profitability and valuation, and then use our fundamental research to confirm whether we think the company will sustain its profitability. So we look for quality companies generating high return on invested capital, strong balance sheet, strong competitive position, good management, companies that can deliver profits. I think that's important in this kind of environment that we're in now, where their macroeconomic outlook is mixed, some geopolitical concerns. And also after the last 2 years, the European market has appreciated quite rapidly, but we notice it's appreciated because of valuation increase and not necessarily because earnings expectations have risen. And so now you might have a bit of almost a disconnect between valuations and underlying profitability. And so for the market to move higher, it will require earnings to be delivered. And so right now you want to be invested in companies where you have confidence that the earnings will be delivered. I think that's, besides the geopolitical issues and the economic issues, that's a key headwind for the market in the next 6 months. Will earnings reflect the valuations that the market has moved to?
Following your view on valuation and earnings estimation, with the current accommodative policy, from an investor's perspective, what do we need to know about the market's valuation and earnings estimates?
Well, the market, as I mentioned, the market valuation has risen. Earnings estimates have basically stayed where they are. So right now the market's trading on earnings 17, 18 times for 10% earnings growth. Now that could be fair in a market which is undergoing a cyclical recovery, because typically when the economy is coming off a trough, you'll find valuations a bit higher in anticipation of earnings recovering. So for the market to move forward, we'll need to see the earnings being delivered. Unfortunately, earnings revisions, that's the ratio of earnings upgrades to downgrades, are actually quite weak in Europe. But they're stable, they're not getting worse. And so there's some positive that perhaps they've troughed and will start moving back up, but the revisions have slightly declined over the past 2 or 3 years. And so we're in a situation where we need the earnings to come through, but the revisions are a bit weak. And so therein lies a bit of headwind for the market in the next 6 months. So the second quarter earnings season that will just finish next week, that will be a very, very important point that investors should look at to gain confidence about further market appreciation.
Once again, thank you, Mr. Stephan, for sharing your insights with us here today.
Thank you.
For more information on unit trust, please log on to www.eunittrust.com.sg or talk to us at any Phillip Securities branches. Thank you.